Welcome to StokTok's deep dive into Boeing. Boeing is the American aerospace and defense giant that designs, manufactures, and services commercial jetliners, military aircraft, satellites, and space systems. At the time of recording, Boeing trades at 223.38, sitting roughly in the upper half of its 52-week range, which spans from 156.47 at the low to 254.35 at the high. The RSI, or Relative Strength Index, reads 58.4, a neutral reading, suggesting neither overbought nor oversold conditions. The 50-day moving average sits at 219.82, and the 200-day moving average at 219.39. The two are nearly converging, which in our view signals a technically balanced but not yet confirmed uptrend. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Boeing's core revenue engine is its commercial airplane segment, which competes in a global duopoly alongside Airbus. Defense, space, and services round out the portfolio, providing some revenue diversification. The competitive moat is formidable: decades of regulatory certification history, deep customer relationships, and enormous barriers to entry make this one of the most structurally protected franchises in global industrials. The StokTok score for Boeing stands at 36 out of 100, a caution signal. Valuation scores 13 out of 20, financial health 7 out of 20, profitability a deeply concerning 1 out of 20, growth 7 out of 20, and smart money 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price-to-earnings ratio for Boeing comes in at 111.13 times. That is, you are paying $111 for every dollar of trailing earnings. That is an elevated multiple by almost any standard. The forward price-to-earnings ratio is an extraordinary 7,977.91 times, which effectively reflects the market pricing in near-zero near-term earnings power. A number that tells you less about value and more about the depth of Boeing's current earnings trough. The EV/EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, a preferred measure for capital-intensive businesses, sits at 27.26 times, which is meaningfully above where aerospace peers have historically traded. The GuruFocus intrinsic value estimate for Boeing, at the time of recording, is 207.29, implying the current price of 223.38 carries a negative margin of safety of 7.76%, meaning the stock trades at a modest premium to that estimate. The Wall Street analyst consensus, at the time of recording, is a buy across 25 analysts, with a mean price target of 266, suggesting roughly 19% upside from current levels, with targets ranging from 200 on the low end to 300 on the high. The next earnings report is due April 22, 2026, with the street expecting earnings per share of approximately negative 0.68, with the range spanning from negative 1.07 to a positive 0.22. That wide dispersion reflects genuine uncertainty about the pace of Boeing's operational recovery, and in our view it represents a meaningful near-term catalyst to watch closely. Market sentiment around Boeing, as of the creation of this video, leans mildly positive but largely neutral. A milestone partnership with SES for multi-orbit connectivity adds a modest constructive signal, though broader aviation tailwinds from easing fuel costs and travel demand are more industry-wide than Boeing-specific. In our view, the valuation setup is difficult to defend on traditional metrics alone, and one would need to underwrite a significant earnings recovery to justify today's price. Moving to financial strength, how solid is the foundation? The Piotroski F-score for Boeing is 6 out of 9. This is a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency. A score of 6 sits in the moderate range, suggesting the business is not in freefall but is carrying real financial stress. The Altman Z score, which is a multi-factor model used to estimate bankruptcy risk, comes in at 1.57. A score below 1.8 places a company in what analysts call the distress zone. This is a reading that warrants serious attention and should not be dismissed. The cash-to-debt ratio is 0.54, meaning Boeing holds roughly 54 cents of cash for every dollar of debt, thin coverage. The interest coverage ratio stands at 0.00 times, meaning operating income is not currently covering interest expense, which is a critical red flag for credit analysts. The current ratio, which measures short-term assets against short-term liabilities, is 1.19, barely above 1, offering minimal liquidity buffer. Debt to equity is 9.98, an extremely high leverage ratio that reflects years of debt accumulation during production halts and operational disruptions. In our view, the balance sheet is the single most important risk factor for Boeing investors to monitor, and the data suggests it remains under significant stress. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, a measure of how effectively management deploys capital to generate returns, stands at negative 4.36%. When return on invested capital is negative, the business is, in effect, destroying value on the capital it employs. That is the most fundamental profitability concern here, and it earns Boeing a profitability score of just 1 out of 20 on the StokTok framework. Moving through the margin stack, gross margin, the revenue retained after direct production costs, is 4.79%. For a manufacturer of Boeing's scale and pricing power in a duopoly, this number is strikingly thin, reflecting the cost overruns, supply chain disruptions, and production inefficiencies that have plagued the company. Operating margin comes in at negative 6.05%, meaning the company spends more running the business than it earns in revenue before interest and taxes. Net margin, after all items including non-operating income, is 2.50%, which is positive, but that figure should be interpreted with caution, as it may reflect one-time items rather than underlying operational strength. Free cash flow margin is negative 2.11%, meaning the company is consuming cash, not generating it. For a capital-intensive aerospace manufacturer, negative free cash flow is a serious structural concern. In our view, profitability remains Boeing's most urgent challenge. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Boeing has delivered revenue growth of 10.3% in aggregate. That sounds reasonable on the surface, but context matters enormously here. Boeing's revenue base was severely depressed by the grounding of the 737 MAX and the COVID-era collapse in air travel demand. So this 3-year recovery figure is, in large part, a rebound from an unusually low base rather than evidence of structural business expansion. Zooming out to the trailing 5-year revenue growth rate, the picture softens considerably to just 2.1% in aggregate, barely keeping pace with inflation over that window. That deceleration from the 3-year to the 5-year figure is an important signal. Growth has been inconsistent, and the underlying trajectory, stripped of recovery dynamics, is modest at best. Book value growth over the trailing 3 years is 0.00%, meaning shareholder equity, on a per-share basis, has not grown at all, which reflects the weight of accumulated losses and heavy debt. Boeing pays no dividend at the time of recording, so there is no yield component to compensate investors for the weight. In our view, the growth profile here is a recovery story, not a compounding story, and the pace and durability of that recovery remain genuinely uncertain. We would want to see sustained delivery rate improvement and positive free cash flow generation before calling this a confirmed growth trajectory. Now let's talk smart money. What institutional capital is actually doing with this name? 20 top-tier guru investors currently hold Boeing in their portfolios. That is a meaningful level of institutional attention for a stock with this many fundamental headwinds, and it tells us that sophisticated long-term capital has not entirely abandoned the thesis. Among the notable holders, Hillman Value Fund carries Boeing at 2.40% of its portfolio, but has been reducing its position by 12.73%, a signal that even a committed holder is trimming exposure. Viking Global Investors, one of the more respected multi-strategy hedge funds, holds Boeing at 2.29% of its portfolio and has been adding aggressively, increasing the position by 31.31%. That is a meaningful conviction add from a firm with a strong track record of identifying inflection points. Sarah Ketterer at Causeway Capital Management has initiated a new buy position. Causeway is known for disciplined global value investing, so that initiation carries weight. Turning to the broader institutional picture, only 15.7% of 13F filers, the institutional investors required to disclose quarterly holdings, are net buyers of Boeing. When that figure falls below 50%, it indicates more sellers than buyers among the institutional community, and 15.7% is a notably low reading. Insider ownership stands at just 0.60%. Management owns very little of the company relative to its float. Over the most recent 3-month window, insiders recorded 1 buy transaction against 4 sell transactions. That insider selling pattern, combined with low ownership, is a factor we would flag as warranting caution in our assessment. And finally, the verdict. Let's bring it all together. On valuation, Boeing trades at a meaningful premium to its GuruFocus intrinsic value estimate, with a trailing earnings multiple that is difficult to justify on current fundamentals. In our view, one must underwrite a significant multi-year earnings recovery to make the price work. On financial strength, the Altman Z score places Boeing firmly in the distress zone. Interest coverage is effectively 0, and the debt-to-equity ratio is extreme. The balance sheet is a source of real structural risk. On profitability, with negative return on invested capital, negative operating margins, and negative free cash flow, Boeing is not yet earning its cost of capital, and that 1 out of 20 profitability score reflects that honestly. On growth, the 3-year revenue recovery is real but heavily base effect driven, and the 5-year trajectory is thin. This is a turnaround story, not a compounder. On smart money, the divergence is notable. Selective high-conviction buyers like Viking Global are adding, but the broad institutional community skews towards selling, and insider activity leans toward the exit. The overall setup, in our view, is one for highly patient, risk-tolerant capital that is willing to underwrite a multi-year operational recovery, not a setup for investors seeking near-term earnings clarity or capital preservation. The data suggests caution is warranted here. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Boeing. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.